Welcome all in share investment and trading session 2. In this session, we will deep dive into the analytical difference between fundamental and technical analysis so that you can confidently understand what factors actually separate these two methodologies. Then I will focus on the candlestick patterns. Let's throw some lights on candlestick opportunities. So what we are going to cover today is the right chart picking, then Japanese candlestick pattern, which help us to identify the trend. The next is we will deep dive into the technical versus fundamental analysis. If you don't understand what you're looking for in a chart, then they will be easily drive you crazy. Trust me. Our goal for this lesson will be to understand how firstly we simplify what we are looking at and then understand what to look for so that we can know exactly how to dissect the markets with effective technical analysis. We are going to be doing this by looking at how price action can create certain price action patterns that can actually be indications of future price movements, then understanding what to do when a pattern actually arises in imperatives, then I can absolutely confirm that uh, you will know exactly what to do when the right pattern arises by the end of this lesson. So look forward to that, the key differences between technical and fundamental analysis. Your view needs to be very much clear when you are looking at a chart. Which political style should you actually be adopting as a beginner trader? Those are some of the questions that you might have built up now. And I'm going to be answering those questions throughout this entire lesson with you moving forward, or at least assisting you come to the understanding of why technical analysis is probably your, your best bet as a beginner trader. Okay, looking at the basics of a charting at a moment, technical analysis incorporates three main types of charting styles, and they are line charts, bar graphs, and candlesticks. Let's discuss them with a little. What you are looking at right now is a line graph. Line graphs are relatively simple to look at, but don't tell us too much information. They are great to track an average movement of price over a period of time, and very useful when looking for horizontal support and resistance level. But they lack the price action details that we actually need to focus on the market with a technical method of analysis. So I'm not going to spending too much time on this line graph at all. But if you would like to summarize, then in your notes, you can just write this down. They are great for tracking. They can be useful in identifying key support and resistance level, but they lack the detail needed for our style of technical analysis. So bar graphs, which are made up of OHLC bars, are probably the closest charting style to candle chart. They show us brilliant views of price action in fantastic detail. With this chart view, you can easily track the open, high, low, and close of each period of time, and easily apply this in your technical analysis. My suggestion, however, is to rather focus on using the candlestick chart. A candlestick chart is probably the most visually pleasing chart you can look at on daily basis. It also shows bar that comprise of open, high, low, and closes at the end of the day. But the only difference now is that there is a body or a box, if you may draw, out between the open and the close levels. So we have already discussed this, but I want to say it again, just so you have solid understanding of the concept. If the close is below the open, then the body and the wick will be in the red in the color, and it will be green if the close of the candle is above the initial open. Being able to see the bodies of the candles help us pick the immediate impact of price movements very quickly, and therefore help us to speed up your reaction time as an analyst. So essentially, that's the main reason as to why this charting style would definitely be my suggested view for you as a new trader. So if you are interested in this charting style, I would definitely recommend to you to take a look at the candlestick chart. In order to get used to the candlestick charts, you need to be as comfortable as possible with the candlestick themselves. Don't let them confuse with your thought, because they are just simple illustrations of a price movement over a specific period of time. Please actually take a moment to write down candlestick are just an illustration of a price movement over a specific period of time. Candles will have look very similar whether you are looking at the 5 minute chart, 1 hour chart, daily chart, or even a weekly chart. You will need to ensure that what you look at the top left of your charting chart. In this charting style, you can actually identify the time frame that you are looking, but no matter what time frame you are looking at, always remember that each bar will always have an open, high, low, and a close. In this example, on the right for the green bar, we can see that the close is above where initially opened. And in drawing your attention to the red bar, the close is now below where it initially opened. The vertical lines above the below and below the bodies are referred to as upper and a lower shadow. They essentially show there where price moved to during this period of time before that candle. Ended up closing and are actually great bits of information. The highest point of upper shadow shows the highest price that was reached during that time period of time. The lowest point of the lower shadow shows the lowest point reached during that time of period. So if you are confused about the wicks at all, I hope that clarify it you. All that they do just shows us a trail of where price move during the candle duration. So if you are confused about the wicks and all, I hope that clarify it to you for. A reversal pattern is formed by price action forming a candlestick in a specific manner that actually gives us an indication of what could happen next. Hearing the term reversal pattern may lead you to think that an old trend is now ending and then reversing to a new trend. The reality is that rarely happen. Trend reversals actually occur slowly and in stages, and that's something you will come to realize the more you learn about them. This is an example of a common price action pattern. It's called a bullish engulfing pattern, and it's created by two different candles. A bullish engulfing pattern is characterized by a bullish candle whose body engulfs the previous candle's body, and you see that very eventually in this example, extent of the green bar, it's open at the same level that the previous red bar and close at the lower level, and it's moved up higher than the previous red bar and engulf all of that work. It was initially done a pure example of a bullish engulfing pattern. This is considered to be a very good indicator of a possible price reversal to the upside. As with many candlestick pattern, it is only relative to the time frame that is being created on so far. Instance, if you see this bullish engulfing pattern set up on a 1 hour chart, then you should only read the 1 hour chart of the bullish engulfing pattern. Think of reacting to it on the 1 hour chart as well. In this example, in the picture, you can see that the bullish green bar is longer than the red one, but it will also still be relevant. If the green bar was the same length as the red bar, then some would prefer to the pattern it was the same length as the red one, and pink trend tracks, which is just a different name for it. And for all different illustration or some ways to identify it, but just understand that it follows the exact same engulfing nature at the end of the day. As it is reversal pattern, so it's only going to be significant for us at the end of a downward push. Please take a moment to just write that down, that a bullish engulfing setup is only significant to you at the end of a downward push or a downward trend. Engulfing pattern. So remember one thing, that a bullish engulfing pattern is characterized by the bullish candle whose body engulfed the previous candle body. So if you can see in this example, I circle out some bullish engulfing pattern, and if you can see here, there is a bullish upward trend is there. So the first area where I marked this is a round circle. You can clearly see that there is a spike after this bullish engulfing pattern. And the second area where I marked is not a relevant one, because this pattern we always check in a downtrend when it's a sign of a reversal. So here there is no downward trend, it is on a same level, so we'll not consider this one. The third one is also the same. You can see the green bar, it's clearly engulfed to the red candle, and then it goes up. And here the fourth example, you can see here, it's a clearly a good spike of a upward direction when after that bullish pattern. Okay, so you can clearly see that in the last example, there is this example, this will not consider as a bullish engulfing because it's on the same level. It should be found at a down level where you can see the positive trend reversal. So that one is not we can consider as a bullish engulfing pattern. Let's look at the bearish engulfing pattern. So this pattern characterized by a bearish candle whose body engulfs the previous candle's body. This is a good indicator of a possible price reversal to the downside, and this is relative to time frame that it is created on, and also this is significant at the end of an upward push. So you always remember, whenever you need to consider this pattern, then this needs to be a rise on the upper side, so that in future you will see some potential reversal and downtrend will get started. Let's look at this chart. This is, and you need to find out the bearish engulfing pattern, and you can see that how it works. So I have marked some pattern here in a circle on this chart. So all are not a relevant one, but you just tell me which one is the relevant one. So the first circle you can see here, there is a upside trend, and then again it's pull back, and one pattern created, the bullish pattern, and then it's going down. So first pattern is a relevant one. Second pattern is also relevant because there is upside push, and then red candle engulf the green candle here. So again you can see some downside trend, and this reversal is there. And then the third one is the perfect bearish engulfing pattern, where you can see the upside trend, and then red candle engulf the green candle, and it continuously goes down. Fourth, I can say also the relevant pattern, because you can see there is the upside trend, and then red candle hit it and engulf the green candle, and then it goes down. Fifth one, I'll say no, because it's already in a downtrend, and we will not consider bearish engulfment in downside trend. Next pattern is a hammer candlestick pattern that we are going to discuss. So remember few things when you consider this as a hammer. The first thing, that the real bodies are near the top of the candle range. Then second thing, they have a long lower shadows and small real bodies. Then it should have no or a very short upper shadow. Then the color of formations are irrelevant. Then pattern is significant when it emerges during a down trade and possibly indicates a reversal trade. Let's look at this chart. I have marked some symbol to identify hammer patterns. So in this chart, I found two hammer patterns. So I told you, remember where you consider the hammer pattern and where it is significant. So hammer pattern, we are always looking at the downside trend where you can see the disturbance and then possibly trend will reverse it to the upper side. So at the first symbol, you can just check it where I mark this pattern. You can see there's a downside trend and then hammer candle created and then market goes up. And then second symbol, you can see it's created on the top, so it's not relevant for us. So we'll not consider this as a hammer. Next pattern is the hanging man pattern. So remember a few things and in a hanging man. So the first thing that the real bodies are near to the top of the candle range. Then second thing that you always remember, they have a long lower shadows and small real bodies. Then it should have no or a very short upper shadow. Then color of these candles are irrelevant. And this pattern is significant when it emerges during an uptrend, indicates trend reversal. Let's look at this chart and find out the hanging man pattern. So I already marked, I found four. So the first one you can see it is created at the bottom. So we'll not consider this as a hammer man because this pattern creates on a upper side and then possibly you will see the reversal trend. So you will, this one, first one is not the relevant. Second one, if you can see, the bodies are a little bit more and the wick is very less, so we'll not consider that also the hanging man pattern. The third one is a perfect example of a hanging man. If you can see the long wick and the body is very small, and that is also created on the top, and then after that market goes down and you will see the reversal. And the last one, you can see that created on a bottom side. So we'll not consider this as a. Next pattern is a V formation pattern. This pattern is made up of three candlesticks, and the color of the sizes are of these candles are irrelevant. Then this candle one starts off as any candle. Then candle two must close with a lower high and a lower low than a candle one. Then candle 3 must close with a higher high and a higher low than a candle 2. And this pattern is an indication of a potential bullish moves. Look at this chart and find out the V formation on this chart. So I already marked few. So let's talk on those. So the first one that I marked, if you can see, the first one, red candles colors are not relevant. But if you can see here, it's created on a bottom side that is significant, and from there market goes up. So I can consider the first one. Then again you can see there is a downside, and at the bottom you can see the V formation, and then market goes up. Next pattern is the inverse V formation pattern, and this pattern is also made up of three candlesticks. The colors of the sizes of the candles are relevant. Then candle 1 start off as any candle. Then candle 2 must close with a higher high and a higher low than the candle 1. Then candle 3 must close with a lower high and a lower low than a candle 2. And this formation or pattern is an indication of potential bearish moves. Let's look at this chart and find out inverse V formation pattern. So I already marked three pattern here. I found the three pattern on this chart. So let's talk on these three. Why I marked and is this patterns are relevant for no or not. So the first one, if you can see, there is an upward trend, and after that you will see the inverse V formation pattern rise, and then market goes down. Again, if you can see, market goes down, again upward push, and then inverse V formation pattern rise. So the second one also relevant. Third one I can say not relevant, because if you can see, so we are already on a going downside. So we always consider upper side trend, uptrend, and then you can see if any inverse V formation pattern created or not. Support and resistance are very important in candlesticks, and it's very good indicator to see the levels as well as to find out the reversal. So always look for the support and resistance in any chart, so that will be easy for you to find out any opportunity available in the market or not. Let's look at this chart. I have marked one line here. You can see the one line on the chart. So what do you see here? So here you can see one range. After that, market cross that range and again goes up, and then again touch one same level and again goes upside, and then again touch on that level and again goes down. So you can see that resistance and support. First need to understand what is the resistance and support. So resistance are always on the top side, and the support is always on a bottom side. So this one is a support at the bottom where I made a line, and on the upper side I haven't marked that is a support. So here if you can see that support line breaks it and then market continuously goes down. If you can see here, its support line became a resistance here because it's break that level and market goes up. So resistance and supports are very important to mark any level or find out the breakout. Let's look at this chart. So I have marked one line, slipping line, and you can see that is a resistance. Okay, at the top I made this line, and from that level market goes reverse. Okay, so always look at that way and check the data for around month or 15 days or more to find out that level and mark that line, and then you can see if that market break that line, then it will be, you can see, potentially upside trend. If market reverse from that side, that level, then you will see the downside also. So these resistance and supports, if you identify that, then it will be very easy for you to do intraday or any trading. Just learn how to analyze the market and actually get a clearer picture of what's happening holistically, so that by the time of you learn your strategy, you know how to build a case and justify a trade entry when the most quality time arises. Okay, so we are just going to take a brief moment to dive into the different analytical aspects that govern the concept of technical and fundamental analysis. Let's understand fundamental analysis first. So the fundamental analysis is generally the practice of evaluating the value of an asset and analyzing the factors that could influence its price in the future. The factors are what really matters, because that's what actually defines this methodology. So let's have a look at some of the contributing factors. Certain events like a country's increase in unemployment or country's economy and monetary policy, and then affect the level of the demand for its currency. If a country current of future economic outlook is good, then currency should strengthen, right? Company reporting, it's very simple to understand, and this one, because this is what you probably understand the most of it. You have ever been exposed to some sort of stock investment? Company reports are taken to consideration by investors who have an interest in purchasing a certain amount of stocks in a business, because the value of an investor's shares will only increase if the underlying value of the shares increase. One of the must be very confident of the company's potential growth, and this is certainly something that a company's reports can definitely paint a. Next chapter is media interpretation and influence. Media influences are really big, really contributing a factor here. Whether or not you read the newspaper, watch the news on the television, follow news on the social media, or listen to the news on the radio, I'm sure that some points in time in your life you have been exposed to the news that wasn't representative of true coverage and or news reports that were bluntly manipulative on the facts. The news can influence trading and investing decisions on a significant degree. For example, let's say on a CNN reports on a breaking news release of a workforce strike in the USA in the oil sector. Naturally, if that had happened because of the fact that USA is one of the biggest producers of oil globally, the supply of oil would decrease and prices would rise and the demand rises too. But what if CNN actually means to say that the workforce strike that's happening in South Africa had made a mistake in the reporting? People who take the news seriously as a contributing factor to their analysis would have probably reacted to the mistakes before CNN could actually rectify it, which would cause quite necessary price movement of the asset, as I am sure you would imagine. When using the media as a source of data and information, we need to be sure of the source reliability and trust their reputability. Fiscal policy is the use of government revenue collection and expenditure to influence a country's economy. Remember that a good economy results in the higher currency value, and a bad economy obviously result in a lower currency value. Environmental influences are the major influences. Next chapter is a company reporting, and it's very important topic because if you are doing a fundamental analysis, it is necessary to refer the correct data, their company sales, revenue, their target, their purchase, everything that you need to refer before going to buy any company share. So company reporting is very important, and the source of data that you are referring is very important while doing a fundamental analysis. Next chapter is a fiscal policy, and which is very important chapter. So uh, you need to sure on the company policies, any changes in the policies that you need to be aware, so that that there will be no impact on your buying decision or your investment. Environmental influences are the major influences to the supply and the demand, but not limited to the agriculture communities. If a country experiences a drought, for instance, there are countless ways that would affect production. We will mainly see the rise in the prices of fruit and vegetables and gains from a country that is generally rich in the production of these commodities. If it had to go through a drought, which could also inevitably affect trading decision and market condition for that commodity too. Let's have a look at the technical analysis. Technical analysis is going to become your focus. We'll be using technical analysis in all of our studies on the market. There are many different types of tools and methods that have been used for decades to produce consistently profitable results. Let's take a brief look at some of the technical tools and approaches we'll be focusing on primarily. As you may, you have already realized support and resistance is a key element to my preferences in technical analysis, which is why I ensure to bring it up as much as possible. We can use support and resistance for a different reasons too. You can use support and resistance for a concept to help you find right time to get into trade, or even use it as a tool to justify potentially profitability of a trade. And what essentially means is seeing if your take profit is actually on the path that is uninterrupted by key levels, which could essentially act as a barrier to the price. I'll expand on the support and resistance every opportunity that I get and will dive even further into the UTP program during the weekly market breakdown videos that I host too. Technical analysis is highly influenced by human behavior. Let's for a moment imagine that 55% of our traders in the market know of or use the concept of support and resistance. And they know that what price reaches a level of support, you should generally look for a buy. And if price reaches level of resistance, you should generally look to go short. Just imagine how many buying and selling influences there would be at a these keys level. But please remember, the keys concept to successful trading is not doing what everyone else is doing in the marketplace, but solely relying on the methodologies that you have studied and that you have understood. The idea is not to follow the masses, but trade a unique style that you are comfortable with, because that's what you solidify your longevity in the marketplace. Technical tools are designed to assist trading decisions in probability, not to give accurate trading signals. And people tend to get that wrong. They tend to use indicator as a way to assume where price might be moving. But you can't just use an indicator on its own. It has to be paired with in hand with successful trading strategy, which just help you as a trader build a case and justify using your strategy at a certain point in time in the markets. Another extremely valuable technical tool is Fibonacci retracement tool. Technical trading relies on historical data to speculate on the probability of what would happen next. We rely on the real data of actual events and the potential occurrence to paint a picture that we will study with our technical tools. This may be one of the biggest key difference between fundamental and technical analysis. Technical analysis is a much faster form of analysis in comparison to fundamental analysis at a retail level. And what I meant by that is where one has dissect the information then. So the beginning at the reversal pattern section, I thought you there three main pattern: hanging man, hammer, and the V and the inverse V formation. And the inverse V is the same concept, just inverse. So let's use those concepts and let's try to find out one of each candlestick pattern. Learn this lesson. So you can start looking for the opportunity now. While I talk them, it's very simple. You're either looking for a hammer at the end of downwards push, or you are looking for a hanging man at the top of an upward push, or if you're looking for a V or inverse V formation. What you are looking at the moment is a bit of an upward trend. So there is a lot of opportunity for a support and resistance here too. So we won't dive into that, but I do want you to look for one of those three advanced price action patterns. What can you find? Where are they? The very first obvious one is right at the bottom left over there, where we have bullish engulfing setup. That's the first advanced price action pattern that we find, which is an indication of a potential bullish momentum and what actually happens after that bullish engulfing pattern. Throughout this lesson, we had a look at the charting variations, reversal patterns, identifying candlestick formation at a key level, drawing a bias for what to do once a pattern arises, and then obviously understanding the analytical difference between fundamental and analysis. That's the end of our training session. I hope you enjoyed the training, and if you like this training video, then please click on the like button and subscribe my channel and click on the bell icon so that you will get the notification for all of my incoming training videos. Thank you.